Most people never get to spend a few hours hearing how a kid influenced by rich dad, poor dad could turn a $36,000 foreclosure on a credit card into a hard money engine and a 4+X industrial fund sale to a JP Morgan platform. But that's exactly what I got to do in part one and part two of this interview with Chris Hanson. He delivers, along with the details, into the tactical discipline that kept oxygen in his business through 2008 and today's recent commercial real estate chaos. You want to know what that tactical discipline is? Buying below replacement costs with real cash flow or not buying at all. And he lays it all out for us in detail. It was so good that it had the book twice because we needed more time to go into his mechanics. So in part two, we go from theory to the playbook, and we talk about why small bay infill industrial may be the most mispriced corner of the commercial real estate market today. How Hanson's taking 6.6 cap rates to mid-8s in under 24 months, and why operational pain and vertical integration are precisely what creates his moat, the yield, and the exit optionality he relishes when institutions finally show up. We unpack cap rate math in plain English so that how commitment and capital calls really work in a series structure, and we lay out exact supply and demand imbalances driving his strategy while much of the multifamily and office is still resetting. It's the first of its kind, two-part wealth building behemoth in one episode today. It's time to go to the atomic level.
It's time to go to the atomic level.
Welcome back to the Atomic Level, the show where we decode the matters of wealth one insightful conversation at a time so that you can grow your net worth as well as protect your net happiness. I'm Chris Snook. Today, I am joined by Chris Hanson of Hanson Capital Group out of Paradise Valley, Scottsdale, Arizona. Chris, welcome to the Atomic Level.
Thanks, Chris. Appreciate you having me today.
It's amazing how podcasting can bring you right back to your and meet people that you didn't meet before. So we were in the green room area and finding out that our oldest went to the same elementary school right around the same time as your kid and your children. And so we have a passionate respect for the former principal there. And so we immediately hit rapport. I'm looking forward to get to know you, though, and what Hanson Capital Group's all about. So thanks for being here.
Absolutely. Yeah.
All right. So as you guys know, when we start these off, we'd love to understand kind of who we're listening to before we understand why we care and what they're doing. So Chris, talk to us a little bit about your journey, just in general, like stuff that maybe you don't get to talk about all the time in the business, but that really kind of shapes your approach to Hanson Capital Group. And then we'll get into, the path to here, like how did you build wealth? How did you help other people build wealth? And then what's changed over time and what are you kind of focused on now as we are in 2026? So start with a little bit of background. Tell us about, your kind of childhood and your upbringing and what made you get into this world.
Yeah, sure. So I grew up in the Oregon area. My dad was more of a hired gun, technology companies, sales driven. Grew up as an only child, really being more involved in business than maybe some kids, and talking through all the principles, watching companies get bought and sold, all that kind of stuff as a kid. And when I went to look for a college, I was focused on entrepreneurship. His big lesson to me was, I don't want you to be, the hired gun who's doing this work. You need to figure out how to do this for yourself.
Wow, that's fascinating, because that is like the complete 180 of, I didn't know anything about entrepreneurship. So it's just so funny when I meet someone who's like, yeah, and then I was going to be an entrepreneur. I'm like, wow, okay, that's cool.
Yeah, I mean, it started with the
what year did you go to college? What year when did you enter college? So what time was this like late 90s, early 00s?
2001, I started college, graduated high school and went to college in 2001.
Okay. So it's very interesting because at that time I was entering grad school in 98, and it was the first kind of time where colleges and universities started to do entrepreneurship as like a program.
Yeah.
So I was curious because I'm like, that wasn't a thing. Like when I was going undergrad, that wasn't even a choice. Not that I would have been aware of it, but it wasn't a choice. But then near the turn of the century, it became a curriculum.
So funny story about that. The group my dad was with was a venture capital group out of the Southwest, and they brought up the term. I didn't know the term. I didn't grow up wanting to be an entrepreneur. I grew up thinking I would be a lawyer or something like that. But at the time, I learned about it as I was searching for colleges. The top school in the nation was University of Arizona down in Tucson.
Yeah, and they went back and forth because when I was going to my second master's degree, because I came up in a different way, I realized I knew nothing about business, nothing about money, and I almost had a master's degree and it was only worth $38,000 a year apparently in the world of San Diego. And I had already moved all the way across the country, and San Diego State at the time had one of the top 20 entrepreneurship graduate programs. And so literally out of pure pragmatism, I was like, well, I'm already here. I might as well go into that program.
No way.
And it was something they were promoting heavily. And the other school that I looked at was actually NAU.
Okay.
They didn't have an entrepreneurship program, but they had a strength and conditioning program, which is where I kind of came out of. And so, the Southwest and then Babson out in the Northeast.
That was the other one.
Yeah, Babson was basically like the one you heard about a lot. And so fascinating. So your dad was kind of part of that movement. That's really interesting.
So, Babson was number 2. And that was the big headline is, hey, U of A topped Babson as an entrepreneurship program when I was looking. And I went and toured Babson, toured Boston College. I was a solid 3.5 GPA, athlete, but I was not the 4.0 stud that was getting into all the big schools. And I think, frankly, my dad liked the idea of state tuition a lot better than private tuition. At the time, I think U of A was like $12,000 a year. Babson was 40. But they had a technology company down there. He arranged a tour from some recent graduates that kind of showed me around the Southwest. And my parents both encouraged me if they could redo it, they would have had more fun and not have been so serious. And as an 18-year-old kid leaving rainy Oregon to go down to U of A, I'd seen everything I needed to see.
That's awesome. That is so cool. Yeah, that's so cool. Very interesting parallels there. I remember that time well, and I remember Babson. And then there was a thing. Did you ever come across? I don't know if this was graduate school only or not, but did you ever come across a thing? There was a competition called the VCIC, and it was basically the flip of a business plan competition or business pitch competition. Because back then, one of the things they all started to do was like the business plan competitions. This was way pre-Shark Tank, pre-whatever, right? It was like, and the VCIC I did in my second year, and it was the competition was in Boulder. So the first time I went to the regional competition was in Boulder, but UT Austin, I think, if I give them the right credit, their business school was the ones who invented it. And it was essentially a venture capital investment competition. And what was cool about it, and really the most educational component, was instead of being the business person pitching, you and your team had to go become the VCs, and you had 72 hours, and real businesses came and pitched you. And then if you got the term sheet right and all the different legal clauses in that term sheet, right? And we're kind of so if you pick the right team, basically based on what the real VCs would have picked, and then if you gave them the right kind of paperwork and term sheets and documentation and diligence materials, then you won. And so you really kind of got to see the other side of the table, and it was rad. And we flew out to Boulder for this regional competition, 6 of us in early 01 or 02. It was after the towers came down, because I remember being on a flight and there was 2 people that were a little bit suspicious, and one of my classmates was a former Navy SEAL, and he freaked me out because the whole entire time from the gate to whatever, he is just stone cold locked in on these 3 people, and he never put his seatbelt on. He was sitting and the whole flight back from Boulder, I didn't sleep because I was waiting for something bad to happen, and that was about the era.
Wow.
But anyway, I didn't know if you came across that or not.
No, I didn't. We did have a project or a program like that, which was kind of the capstone of the organization or the program. But what was so unique at that time, I mean, again, looking back as an 18-year-old kid, I had no idea what I wanted to do. And it wasn't until I had graduated from that program and realized you don't get to go into venture capital when you're not born into it and you don't have a big checkbook. I guess I'll start a company, kind of was the approach. I went into traditional banking shortly thereafter, but that program was taught by a faculty that was not traditional education teachers. They were people from the business community that came and had actual track records, actual, meaningful knowledge to transfer in their respective areas. So the last 2 years of that program was just phenomenal because it was real, business success people sharing real world wisdom. I say frequently my degree didn't ever help me with anything, but the exposure to that, it's not like you can get a degree to be an entrepreneur, like your management degree qualifies you to work at McDonald's.
Right.
You can mow lawns after you get the entrepreneurship degree, and that's not knocking U of A or any of the educational programs, but that program was interesting. And to my knowledge, I don't know if it's still this way, you had to have a dual major to take the entrepreneurship degree because it wasn't really a curriculum.
Right.
I dropped whatever I think it was business management was my primary degree, my junior year, and graduated solely with an entrepreneurship degree. And at the time they said, nobody's ever done that before. What are you going to do without, a real degree? Because it was like an additional, extra at the time.
Yeah. No, and it makes sense. I mean, I actually, funny that you say that. I didn't think about it at the time either, because I don't know if it was mandated. It may have been. But my actual master's degree that I ended up getting, I went back to get, because to your point, I was about 18 credits into my entrepreneurship master's degree, and I realized I still didn't know anything. And I wasn't going to learn it there. And my story, which has been long documented, so we won't bore me with it, but for your purposes, I decided I'm going to go start a business. And so I did. And then I spent 4 years, never got to revenue. It was a real estate hybrid play too. So we'll talk about some of that because I learned every lesson the hard way that you could ever learn. Went $500,000 in debt. After I went $500,000 in debt, then I realized I'd learned some things that were entrepreneurial. And I spent the next couple of years earning my way out of it. And at the end of kind of getting back to even, I had done all kinds of stuff, investments in real estate, things like that. And I was like, you know what? I'm going to go back and finish that MSBA now because I actually have context. And I want to connect. I need their network. And so I went back for the same reasons that you discovered were the real value, which was the exposure and the network of people that were now teaching that had also done it before. And so it's funny, but I had an entrepreneurship and finance kind of thing, which was the dual, the thing coming together. So, all right. So then fast forward, what else did you say you did? You were an athlete. What did you play?
I played baseball, played basketball. I was tennis, and I ski raced. I raced competitively since I was 3 years old in alpine skiing.
What event?
Giant slalom and slalom were the two through high school.
Wow, that's gnarly.
It was fun. I mean, I grew up around that. I kind of grew up a little bit around motorsports, so speed has always been an addiction for me. One last thing on that entrepreneurship program was one of the most impactful things that probably steered me towards real estate was, if you remember Kiyosaki's book, Rich Dad, Poor Dad, as you can forget, the author of that with him was a woman named Sharon Lechter. Still.
I know her. I've met her a couple times through a mutual friend, Greg Reed, that we have. So great lady. Yeah.
Her and her husband are awesome. She came down to the school and brought Kiyosaki's game, Cash Flow, and that was like a day event. She spoke to us at the entrepreneurship program, and I started reading his books, and that came full cycle for me in real estate a decade later when they were in my audience at an event I was doing on real estate stuff, and I attribute kind of the drive to go after it and create it myself in that fashion, more cash flow focus, which I'm sure we're going to get more into. But we are going to,
and it's funny. We have when you come up in a certain era, I'm slightly older than you, probably 5 years or something like that, based on kind of some of the timing. But it was at that same time one of my first exposure points, because I did not come from an environment where entrepreneurship was a thing, let alone talked about, witnessed, or done. To us, dentists, lawyers, medical doctors, they were quote unquote rich because they lived in different neighborhoods than I lived in, and they actually had assets, but I didn't even know what an asset was, right? Like, in other words, we're base boning it. So at 25, I'm in grad school at San Diego State, and I'm working in a bar, and I've got more letters behind my name than are ever going to be in it. And I realize I don't know anything about making it out there. And to your point, I don't know, maybe today's different, because I think kids today in some ways have advantages that we didn't have, and in other ways are more lost. But I don't know that any 18-year-old kid really knows what they want to do. Right. And I always thought the idea of going to college, like, I understood it for certain things, but I was like, why? Like, I don't know what I want to do. I don't want to waste my money. Like, I don't know what I want to do. But sports was a reason, because it allowed me to continue my athletic career, similar to you. And I'm super grateful for college. So I'm very grateful for the collegiate experience that I had. But at 18, I don't know that anybody knows what to do back then, and maybe they don't know now. And so doing things, entrepreneurship was kind of a practical way to do it. But Rich Dad Poor Dad was one of the first books. Think and Grow Rich I stumbled upon. And then Rich Dad Poor Dad was one of the first probably 5 books that I read, because it was easy to read. Yep. And it was so practical and like insightful. I went, and then I bought copies. I mean, I was 26 maybe, and I bought more money than I had. I bought the Cash Flow for Kids game. I still have it. I bought, when it first came out, I bought like all of them, because I'm like, someday I'm going to have kids and I'm going to play this game with them, you know?
Yep. I'm going to teach them this stuff.
It's sitting two rooms over. It's still in beautiful, pristine shape. It's been, I've got young twins now, and I've got a 14-year-old, and he's played Cash Flow with me like 2-3 times. But yeah, it's funny. It was a great teaching tool. The game was amazing. It's a fun game to play.
Yeah, and the dichotomy of that story of the rich perspective versus the poor perspective or mindset, that just was really impactful for me. It took a long time to put it into practice for me, but
it's also one of those where I laugh because we'll get into some of your lessons learned along the way too. But I laugh because along the way, how did I complexify this whole thing? Like, it started out really simple. And then, you get going, and you have your ups, you have your downs, and you take your eye off the ball, but you don't realize you took your eye off the ball, because you're still doing something new. And it's not the shiny squirrel thing necessarily, but it's like in tech and in innovation, where I ended up landing since 2009. It was like, it's very easy to get distracted. And then you go, wait a minute, cash flow. Holy crap. Like, cash has always been king. That's so cheesy, but it's so true. Like, it's the oxygen. And, the hair that I no longer have, that I willingly shave now, because it makes me look younger than I am, is lost simply over the fact that I forgot about cash flow, right? Like, every time I've had an issue, and the analogy I give it, because you're an athlete who went 90 miles an hour, 80 miles an hour down a hill, you could be the most muscled up, in shape, fit athlete in the world, but if somebody holds your breath for 5 minutes, you're dead.
True. Except maybe your Navy SEAL buddies.
Yeah, they might go 5.5. Yeah, right. Yeah.
It's bizarre, and I find myself coming back to that now. The tough times remind you that lesson. The easy times, which the free money era, and in the real estate world, a lot of money's been created, myself included, focusing on growth as opposed to fundamentals at different points. And that's something that this last period of time has just been so impactful on. We can't lose sight of that. We need cash flow.
Yeah. So let's talk a little bit about, kind of Hanson Capital and its evolution. It's evolution, because you've implied that, there's been different phases of it. So walk us through kind of the evolution of where you started, where you kind of made it, where it broke down, and then where you kind of are today.
Yeah. So I got out of college, went and interviewed at some real estate groups, and realized that I didn't have the rich network of property owners to sell. And when I say real estate groups, I'm talking commercial real estate, Marcus Millichap, CBRE. You go talk to those guys, they say, yeah, we'll give you a job. Who do you know? Because selling buildings when you're 20 years old requires family or otherwise bigger connections. I didn't have any, and they didn't pay anything. I mean,
Right.
a $12,000 base was like a gift, because for the most part, you were getting minimum wage to work a phone all day, and I couldn't afford it. So my dad, I had been selling, I bought cars. Like I've always been a car guy. So I'd find like nice BMWs and go. I learned real early from dad, you make money buying things, not selling them. So I'd buy things in college and resell them and make $4 or $5 grand. So I had been doing that as a way to play with stuff. And I ended up going into a banking career. I got a job at Wells Fargo's mortgage bank doing wholesale mortgage in late 05.
I was out of it by then.
We got a lot of crossover, don't we?
It's so funny. It is hilarious. I mean, it's so funny since, this was totally something that serendipitously came onto the calendar for you and me in the last 24 hours. It is funny, like from where we live. But go ahead. So you got into wholesale. Were you working as an AE, or were you running a room, or what?
No, not yet. I was a customer service rep taking scenarios on behalf of the account executives. And I had been begging the regional manager to give me a shot at sales. And she gave me the non-productive, the inactive accounts, and said, okay, if you'll work extra hours, you can start calling these accounts. And I learned my first tough corporate lesson. I turned the inactive accounts into the most productive territory in the region, and it was promptly taken away from me and given to the top account executive. So it was about an 18-month process. I learned some lessons. I made some money, but I mean, I was still in my early 20s, making a couple $100 grand a year, because the internal pay comp structure, they gave me like an internal sales comp structure. It was like single basis points, there was no real money in it.
Right.
And that kind of slowed down dramatically. I left to go start.
Was that commercial or was that mostly residential?
It was residential prime paper.
And were you still in? Oh, it was prime. Okay. And then were you still in Arizona?
Yeah, down in the Biltmore area at their office.
Okay, so you had gotten into Arcadia, Scottsdale at that point. You were so that's
my territory was regional. So I was calling on New Mexico. I was calling on Las Vegas. Everything that was high production and Phoenix-based was already with our top producers. So I was calling all these, kind of like small, off the beaten path, mortgage shops that were signed up with us on a wholesale account, and getting them to start sending their business back to Wells Fargo.
So you guys were providing the warehouse lines because you were at Wells.
We were talking individual scenarios. It wasn't even warehouse lines.
Oh, okay. So you were basically on the distress desk. Is that what it was?
Well, no, because it was prime stuff. So it wasn't distress. It was, I'm, John Smith, mortgage broker at John Smith Mortgage Banking, and I'm going to send this file to one of, Countrywide, B of A, Wells, and I was on the Wells side looking at those before it went up the ladder further.
Gotcha. It's funny. Like, so quick story, you'll appreciate anybody who was in that space. Like I think it was February of 2002. I want to say it was February of 2002. I got called in January. I got called by a buddy of mine who was an investment banker and knew some people in Orange County. And obviously that's where a lot of the shops were, like a lot of the shops that moved the paper. And they needed somebody to kind of override a room and train people to read rate sheets. And
what I was an expert at.
I was good with numbers. I was good with numbers, and I was good with training, and and I wanted to make some money, and so I was like, okay, because I was still in the like $300,000-$400,000 in debt range, right, from that failure, right? So I was like, yeah, sure, I need a gig, I'll go do that, and I did it for under 90 days, and I remember I never made money faster in my life. I mean, I never really made money like in my life at that point. I'd lost money, so I knew how to spend it, knew how to raise it enough to lose it, knew how to put my own money in to lose it, but I'd never actually earned like real money.
Yep.
And the first time I'd ever made $20,000 in a month was that February. And by the end of March, I was out of the business. It was that fast. And there was two things that happened.
Are we talking about weight then?
No, I'm talking about I'm talking about by April of 02.
Okay.
I was out. I did it for 90 days. I made about $150,000, $145,000 if I remember right, in like 75 days of actual work, and I was putting in 2 times a day at the gym, right? Like I was not grinding. I was working hard, but I wasn't grinding like I had, right? And I went from 20,000 net in a month to like 75,000 30 days later. Like it was like boom, boom, boom. I was like, holy crap! Like,
yep.
But there was two things that stood out. One, New Century had a line. We had a warehouse line from New Century, IndyMac, and several others. And one of the gals that used to not work in finance and worked in a different industry where she sold stuff in Orange County, she came in panic, and she had given a personal loan, but she didn't think it was like, she thought she screwed up. She thought she was going to get fired. So we went through the rate sheet, and I'm showing her how to read it. And it was like a 480 FICO. I mean, it was brutal. Like there was no reason this person should be able to borrow anything, right? At all. Yep. But sure enough, she hadn't screwed it up. They had a program for it, and it was like, it ratcheted up to like 10.2. So this was in the subprime world, right? Well, everything was getting pushed into 228s and 327s back then. I didn't understand why, right? And the 228, hard prepays, and the 327s, all I was told was that Wall Street wants them. That's all we were told. I didn't even understand what that meant, because I didn't understand what was happening afterwards, because we never held the paper. We originated it, and then like by Monday morning after that Friday close, it was off our books, right? And so I kind of understood that. So it felt fast, felt good, but I didn't see anything wrong with it. And I was a real estate guy. I'm like, hey, cash flow is king. People are buying houses. This sounds like a good thing. So about 75 days in, that happened, and I realized that we're giving anybody a loan. And I literally went home on Friday night, never came back. But right prior to that, the other trigger was because I was in wholesale, I had stood up a retail mortgage shop, because back then, there was like, especially, well, in California, I don't know about in Arizona, you could basically get like I forget what it was called, a CRE, or there was like a license you could get where you didn't have to be a mortgage banker or a broker. You could just hang yourself with somebody who was, and then again, originate and make money. So, like all these things out there, from MLMs to whatever, we're doing like mortgages now, right? And so I had a retail business. So I took some people that were looking to refinance their house that I knew, and they had like a 740 FICO. They were prime. And I was like, well, listen, I'll take care of you. And so I put them through the machine, and they got pushed into a 228 or 327 hard prepay. And I just was like, why? And that's just how we do it. That's what Wall Street wants. And at that point, they were like doing some other things. And so I explained it to them, but I didn't my retail guys didn't really explain it to them. They were friends of mine. So I was kind of trying to stay arm's length. And I felt so bad, because I'm like, these guys don't need to be in a hard prepay situation. They have 740, 750 FICOs, but no one seems to care. They're just pushing them all on the same product.
They don't care at all.
And so after the second thing happened, I just was like, I don't really understand what's going on. I just know it doesn't end well, and I think I'm out. And for the rest of that year, it was almost like I punished myself without realizing it. But I read a book called Psycho-Cybernetics that later made me realize I had hit my set point. Like, I made $150,000 in the first 75 days of the year, and I had never made more than $150,000 in a full year. So I shouldn't go above that. And so for the rest of the year, even though I was not clear on it, I kind of set pointed out. And I think I cleared like 159 that year in total. Right. And it was like, it was totally unconscious, but yeah, I got out of it. And then by 05, everyone I knew was selling their property that had money and renting. And it didn't make sense to me, because I was like, you own my dream home. Why would you ever sell it? And I thought it was all going to end in 05. So like I literally got rid of all the properties I owned, anything that I had that was a flip. I dumped them all. And in April of 05, I'd been married like 90 days. I sold my last property, and I exhaled, because I had lost like 30 grand in profit, but I was still like up on it. because the market had started to soften as far as, the volume of churn. And I remember thinking, thank God I made $55,000 in profit on that property, but I don't own it anymore. I got out. I can wait. And California is done. I'm going to go to Arizona, because at the time, California was like, Arizona was still cranking.
Yeah. Yep.
And I'm like, I can't buy anything more in California because it's played out, it's maxed out, it's pumped out, right? And now I don't own any, so I'm safe. Like, if I'm going to keep reinvesting, I got to go to Arizona. And that was the first time I went to Phoenix. But again, I thought in 2005, when you were getting in, I thought the whole world was going to blow up.
Yeah. It was such a crazy time in hindsight, because our primary paper was, 80/20s, 90/10, with seconds, and we're bundling the whole thing, giving people, option arms and things like that. And we're like, so you're buying $1 million house and you're making a $3,000 payment at a 6% interest rate. Yeah, it's not that's possible. Like, huh? Well, that's creative, and that was with Wells Fargo. But when that
the gal that bought that last property for me, thank God, but at the time, because I didn't think anybody else was going to buy it, was in Oceanside, California, but she worked for Countrywide, and I think she basically got 100% plus carrying costs, or like plus the closing costs. So like her loan was like 105%.
Yeah, sign here and you're good.
Yeah, so I sold it for $635, and when it got bought again later in like 2010, I did the research on it. I sold her that house for $635, which was my primary kind of house. I was lease option flipping it, but I sold it to her for $635, and she did 100 and something thousand. She put money into it, and it got bought out of auction for $280.
So, perfect transition to my first commercial real estate deal. I'll fast forward through mortgage. I left mortgage. It blew up, May of 2008, and I ended up moving to Dubai with I was dating the daughter of a guy who was a pretty big residential real estate developer here, and he moved to Dubai with them and kind of learned about commercial real estate from Dubai for about 9 months. When I came back, I started buying foreclosures at the foreclosure auction. First house I bought was 36 grand. I cash advanced my credit card to buy it. It was a house out in Mesa. I was sitting at the property, watching fix and flip, hiring trades, watching, no idea what I was doing. And I could spend a bit of time, because that's the start of Hanson Capital Group. But my first commercial building, I bought a 7-unit apartment complex out in Buckeye for $110,000. Sorry, $72,000. And the guy who'd bought it, this was March of 2009. The guy who'd bought it before me was in July of 2008. He paid $630, like your Oceanside example. I paid $72,000, and my dad and I split it. I think I put in 30 and he put in 50 or something, and he lent me the money. It wasn't a freebie, and I was terrified. And I was going back to those Rich Dad Poor Dad books. Like, I know it said in here how this works. If I can get the cash flow, and that was all the money in the world to me at the time, because it was so. And having it watched it go from 600 to 70, I'm like, well, I guess I can't lose more than the 70, or maybe I can. I didn't even know what I didn't know at that time. And that was for commercial property that I bought, and it obviously evolved from there. And I skipped over a few sections, but the 600 something to 280 felt massive. 600 something to 70, it was just like unbelievable to me.
Yeah, and we forget those times weren't that long ago, right?
No.
So you kind of timed it perfectly. You had the guts to write the check at a time where people really didn't know whether they could or should, because when something like that was happening, I'm assuming this is like when was this, 2010-ish?
That was March of 2009.
March of '09. Yeah. So no one knew. I mean, the thing hadn't even sorted out at that point.
Prices were still going down. My
Yeah, they were
residential
still.
I was buying things, and the game at that point was buy them at the auction, do a paint and carpet, lipstick rehab, and then
Yep.
resell it before it depreciated below your basis, because the prices were down. So it was, I can get a big enough discount at the auction where I can improve it and resell it before I lose my ass on the deal. And, you know, I wasn't the greatest at that. I had spent all the money I'd accumulated from mortgage and, you know, had taken cash advances. And as I started doing those, I had a few buddies who said, hey, would you help me buy houses at the auction? And Hanson Capital Group started as me flipping some houses, which quickly evolved into an auction bidding service. I had a website, investazhouses.com. And the market back then, if you're familiar with the foreclosure sales or the trustee sales, it was $3,000 to have somebody who was standing at the courthouse to bid for you. I bought a Prius, wrapped it in investazhouses.com and Hanson Capital Group logos, and made these stickers that said foreclosure bidding services $1,500. And I would drive around at 4 a.m. and put the stickers on all the top houses for the day. And that's how I generated the first calls. So I created a service business around the auctions, and that.
So you're a picks. Were you taught to be a picks and shovels guy, or was that more organic for you?
No, that was kind of organic. That was more necessity. You know, I hadn't figured it out. I didn't show up with the strategy. When I started buying those houses, I realized the flips, one, they take a while, and two, you're dependent on service providers. I wasn't a realtor, so I had a realtor who quickly figured out if she inflated the pricing that the home would be worth, I would buy it instead of have her underwrite properties for me every single day. And the bidding company that I was using offered me $200 a day to go drive the properties for that morning, because they said most of the properties we're looking at are for you anyway, but we want pictures and stuff for our other customers. They were buying, you know, 10 or 20 properties a day at $3,000 a pop. They were making a lot of money. I was just a young kid. They're offering me $200 a day. And I just traded my 7 Series BMW from being a mortgage guy in to buy a Prius, because I was driving around the city all day. And that was a memorable moment. And I paid another guy $100 to go do the work. So I created the service, realized these guys are buying 20 houses a day. I can do it for $1,500 a day, and I'll pay a guy $500 to stand down there. So I created this auction service business. And shortly after we started our hard money lending business, I had somebody approach me and say, hey, why are you paying cash for all this stuff? You could buy more house debt. You finance the debt. And short, and I at the time, I was paying him a fee to give you a loan. If you were my customer, I'd pay him $1,000. I'd charge you 18% interest. I couldn't take a fee. It would have been illegal. And then I did all the servicing for free, because it was kind of my loss leader service to get you to buy 2 houses instead of 1 house. And then we got our mortgage banking license with the state of Arizona in 2009. And that's always been an ancillary, you know, that's been the high yield savings account. At the time, you could get 18% plus a point or two. You know, now it's much more of a commodity, but I've always kind of maintained business. And I keep it today in my asset allocation. It's a high yield savings account. We've never lost money in the lending space. You might end up with a property, but you know, if you underwrite well, it's asset-based lending. That made more sense to me than the loans we had been making when I was at Wells.
Yeah. It's fascinating listening to you, because there's a DNA level of your entrepreneurial journey that I think is innate. And then I say that because I think that entrepreneurs are a DNA level thing. You can learn to become entrepreneurial, and there's a lot of benefit to that. And but there are people that are just innately built to see arbitrage, and others don't. And again, that's my bias. That's 25 years in. Because I've tried to quit being one so many times, because there's dark days sometimes when you're in that world. And there's been moments where I've tried to go get hired by somebody, and it just never happens. And you end up either not eating and dying, or you end up coming up with the next idea. And and so when I'm listening to you get paid $200 a day, my opinion, a DNA of someone who's built like with an entrepreneurial DNA strand immediately thinks about, how can I do less work and still make money? Right. And so that's a different way of organizing it. Whereas somebody else might go $200 a day. Okay, let me figure out how to live on that. You're like, no, that's seed. How can I turn that into $2,000 a day without me having to do all the work? Right. You can teach somebody that, but they won't get it organically.
It's irrational. It worked in that scenario at that point in time with those set of circumstances. That was the play. The lesson of that is, man, good luck applying, the logic of it. But I agree, what you're saying resonates a ton, because I kind of have a weird thing with numbers. I mean, mental math, or you could put a spreadsheet up in a conference room and I'll tell you these 3 cells are miscalculating. And it's just, I see it. I get I'll say teased in a friendly way amongst my closest friends of like, this guy's Rain Man. He's a human calculator. Just sees things differently, because I do see opportunity differently. I see risk reward very differently. I still tell our lending customers, it's the only business I'm aware of, if things don't work how we expect it to, it works out better. Because if we get paid as planned, it's a tolerable, low double-digit return. If they mess up, we have huge windfalls. I don't know many businesses where you go to sleep at night and you go, well, if the customer screws up, it'll be okay. Usually it's a problem in the business world when that happens.
Unpack that. I'm interested in a use case. Give me a use case that brings that home.
So, a guy takes $1 million out against his $4 million retail center because he needs cash for something. And the note rate and we'll use today's numbers because they've changed, right? But today's rate might be 10.9 on that paper. I'll give him the $1 million. I'm 25% LTV. I'll happily collect my 10.9 coupon. Well, the bank will take their point or 1.5, and then I'll take 9.5 or something as the LP investor in that deal. Individual deed of trust loan. If the guy has issues with his plan and he doesn't repay me on time, he's paying renewal fees. If he gets maturity default and we don't want it, there's a number of ways he defaults. Arizona, for years and years, as long as I've been in the business, default rate's 36%. You get to pick that as the guy writing the paper. But now that $1 million note, instead of paying 10 grand a month, is paying 30 grand a month. And you're looking at 360 of cash flow, assuming it redeems. If it doesn't redeem, you own the property for $1 million and you go turn around and fire sale it for $3 million. You gotta, you 3x your money. And in theory, it's
is the 36%. Is the 36% that you're talking about there because of the tax lien, or is it not tied to the tax lien?
Just simple interest rate. If you quit paying, your credit card 15.9% or something, like your mortgage on your house, it probably goes from 6% to 12 or 16 or something. The hard money guys have their bangs out a little more, and it goes from 12 to 36. The lowest kind of the conventional hard money lender guys I know might be 24%. We just started at 6 because it was double the initial rate when we started. It'd go from 18 to 36 if you default.
Wow, I didn't realize that about Arizona. So now you just unpack that, it makes total sense. So the question then becomes, does that change going forward? And again, I don't want to skip over things that you think are material to the context of what you're focused on now, but that seems like a pretty good thing to keep doing if your job is to, manage risk and also create IRR on the upside in a market that could be unpredictable. What do you think what do you think the world looks like, whether it's in residential, commercial, whether it's regional, or whether it's solely in Arizona, in today's world of, just being too far into a free money bubble, coming into a world where we're probably going to start printing like crazy again because of pure mechanics. We have to AI eating everything. Like, what do you think happens from here? Is the game over for you in that kind of return, or is it just steady, or does it get better?
For me, I've always called it a high yield savings account. That's what I view it as. So it's where I park money that is not deployed into real estate deals. Like you said, in a high inflationary environment where we're printing our way out, the last thing I want to own is paper. But through most of my, meaningful real estate years, interest rates were near zero anyway. So the concept of getting a return, the days of 5% money market yields, I'd never seen in my professional career until COVID. So if I could park it, and it hasn't always been 10, 11%, it's steadily come down. It's commoditized. In California, hard money was more like, 9 to 12, while out here it was still 12 to 16. We lend regionally. I like to spread it out. I've always kept an allocation there. Today I probably have 10 or 15%, but I'm sitting on more cash than, and to me, that's a cash equivalent, because we can sell that paper, we can turn it into cash. I don't like it in an inflationary environment, just for that reason. You're eroding your value. If we're going to be in a high inflation environment, I want to own assets, not paper. That being said, if money markets are down to 3 today, and I'm not really a fan of traditional stocks just from the PE ratios being at record highs and things like that. I'm not a stock guy. I stick to what I know. Anytime I venture out of things that I know, my result isn't awesome. And I've had absolutely phenomenal results in real estate because I just stick to some very basic parameters. And that has been the trend, despite our asset class has shifted over the years. Opportunistically, we've gone, I started in houses, I got into apartments. That had been our bread and butter. I've done some retail, I've done some office, kind of opportunistically. Because of our lending business, that kept deal flow where I get, I see what everybody's doing. We get all those deals come through the door. And I had a great network with commercial real estate brokers to just say, hey, this is a deal we're looking at. If I lend this on it, I want to know the sell it in 30 days price. It was just really pure, downside risk avoidance of really low LTV. That's always been our bread and butter. We get beat by the guys that are going to do 90% of cost plus 100% of construction. And that's fine because, one of the bigger lenders in town, he took back 100 properties in Q4. And, he's not equipped to manage REO inventory. And it's not a knock against him. He's a great friend and they're a good business. But our lending is our sleep well at night. It's our high yield. It's our bond of a traditional portfolio. I'm way more into the real estate itself. But I think that banking background and that banker's mindset has been a material competitive advantage to us because we understand banking. We are bankers. We service all of our own paper. And when it's working with our banks on what I'm borrowing against, they're not always used to the borrowers being as sophisticated on the banking side and presenting a package. And I don't just mean a nice presentation to say, hey, give me the loan on this. We've got phenomenal banking relationships that are very material in our real estate with a regional bank. I'm signing recourse on it, but I believe in our strategy and I can get, rates in the 6s today on vacant commercial real estate that I'm buying below replacement cost. Most guys got to use bridge debt or hard money for that. I've got a balance sheet that will support me signing for it. And I've got a bank where I'm in their top 20 customers. So I know their C-suite. The relationships that you get out of, never making a missed payment, just being 100% with what you say you're going to do. It's material in this space because those banking relationships dictate outcomes, far more than, just simply knowing what color to make buildings and things like that. You know, it's the foundational structure of your deal is your debt structure, and most people don't focus on it to the extent that we do.
Yeah. So are you guys structured as a fund? Are you still syndicating? What is the business model today as far as the capital that you allocate?
Yeah, so we run a series limited partnership. So it's a fund. We're on our third industrial fund today, but we really syndicate individual series within that structure. So it's not a fund in the traditional sense where it's open-ended, and it's not a fund where you can buy in today and participate in assets that are pre-existing. I'll identify an asset or two assets and call that a series, and I'll go raise the money for it. Most recently, we bought a single asset in Houston in December, 34 million and change purchase, about 40 million total capitalization, raised 17 million in equity to go do the deal. And that was series 2 within our third fund. Series 1 in that fund had 2 deals, another deal in Houston and a deal in Tempe, Arizona. Our first industrial fund is 5 properties in a single series. And I think the multiple property per series is over, and I should break that down because it's important. That allows our PPM to persevere over a certain duration of years. Our first fund had 18 properties, but I only had 1 fund created. So each series has its own EIN, it has its own tax return. Every LP gets a K1 for whatever series they're a part of, but it really makes it more efficient for high net worth or family offices that do follow-on investments. I continue to publish deals as we find them, and they can participate or not participate, as opposed to a blind contribution. You allocate $5 million to us, and then you see what you're buying later. We're letting people participate in identified assets with a business plan that either resonates with them or doesn't. And we don't have to spend the 20, 30 grand on a new structure every deal. So it just makes it more efficient for the additional series or follow-on investment. And we're
a lot of the audience that we focus on, meaning 80-90% of it, falls into a category of high net worth families that have somewhere between 2 to 30 million, 2 to 40 million in investable assets, or RIAs that have between 250 to $1 billion under management as kind of like a boundary.
Yeah.
And we've focused, you know, our channel and our content and everything in that service category, because I think that is what I call the, you know, a high net worth orphan.
Yeah.
Because they have real money, 7-8 figure family or individual, but they can't afford a family office. They have a hodgepodge of different advisors, but they probably aren't talking to each other in an organized fashion because they've cobbled them together along the way. And they typically built their wealth in an entrepreneurial way, like you did, or like I did. And so they have like their thing, right? And maybe it's real estate, maybe it's whatever it is, maybe it's small business ownership or whatever it is, professional services, maybe that, you know. So it's they don't have the infrastructure of $150, $250 million family where, you know, they've got an organized multifamily office or something like that. So I say that because I think what you're doing is focused on a very similar persona. How do you get to them though now? And then how do you work with the linchpin advisor, if you do at all? Are they using self-directed IRAs? Are they coming through an alternative asset bundle with their advisor that you kind of use as a sponsored network? Like, is Hanson Capital like a sponsored network for advisors? How do you get most of those new bodies into your portfolio today?
Yeah. You know, we have recently, and I say recently, last year, started marketing to the high net worth space. Prior to that, it had been, I'd speak in real estate conferences, but it had mostly been word of mouth and referral. We've got about 350 limited partners. I've never cracked the code of the broker dealer network. And the RIAs, we get a lot of investment from those guys because some of the principals of these invest with us, and they'll refer us to their customers, and same with shared family offices and such. But I can't really wrap my head around a 6 to 10% fee load on the way in. That's a huge hole for me to dig out of. I can't pay a wholesaler or a broker dealer a huge fee to bring money in. I've been lucky enough that the deals we've wanted to do, I've been able to capitalize them with the network we've created, and our customers have referred a lot of their friends our way, which has left me in a position where if we needed institutional capital, we've had it available. We understand and work with institutions. But you asked me before we started who I serve. I really serve the high net worth guys, and we've never made that transition to full institutional capital because it's the families and people we work with that I get the fulfillment out of serving. And the comp structure when you work with high net worth direct is going to be better than paying, because I can't pay 10% out on my side, 10% on the way in, and still figure out how to get it. We play, right. I'll say, smaller ball that's grown. A $40 million capitalization deal is a good size deal, but I put in 2.5 of that. I'm our largest single check writer on, I think, every deal we've done. There might be a couple that I wasn't the largest check writer, but I'm 27% of our total AUM. I lead with investment. My team is heavily invested. The balance sheet of our management team is in our deals. I don't have investment deals outside of our partnership deals. And because I kind of run a shared family office, I've got legal internally, I've got CPAs internally, I've got property management internally. The only thing I don't have is like conventional wealth management, for traditional stocks and bonds. I have some of my idle cash. It's always been sitting in JP Morgan's private bank because I've got reserve and liquidity requirements. I owe over $100 million in commercial real estate debt. I keep my money in money markets to meet those provisions. Everything else I have is in our real estate deals. So I'm all in what we do in every sense of the word.
So I appreciate that. I appreciate the transparency. I think, so does the audience. That's what it takes nowadays to, I think, earn people's respect and trust is just like authentically going, here's what I do, here's what I don't do, here's what I got it, here's what I don't have, so it's awesome to hear you kind of just say it so matter of factly. Tells us a lot about who you are and the people that serve you, why they keep coming back. Where do you think we go from here in your world, right? Like there's all these forces. You've got, you've got the force of AI converging with the force of free money, with the force of a complete re-engineering of the global economy's order. Yeah. And you've got kind of, especially in the market you're in, which I felt like I'd seen this story before. So my wife and I decided to exit any hard asset real estate that we had, including our personal property in Arizona in 2022, because I thought of it as 2005.
Yep.
Right. I'm not saying that I have a dog or thesis in that hunt. I could argue Arizona is one of the strongest growth stories out there because of just what industries have migrated there, with what has exited neighbors like California and doesn't want to go to Florida or Texas. But a bubble's a bubble. And when I moved there in 2015, it was the cheapest, most wonderfully beautiful place I had lived in 20 years. And when we first got there, the place we were renting in South Scottsdale, because we didn't know where we wanted to be yet. We just knew we wanted to be in that corridor of like Scottsdale, Tempe, and in a nice part. And we were young and nimble, or our kid was young and nimble. So we basically were like, okay, let's rent down at South Scottsdale over in Sky Song.
Yep.
And so we lived there for, I forget if we were there for a year or whatever it was, but no joke, a 2-bedroom, 1 bath, 1,200 square foot place with all the amenities of Sky Song right in ASU, like right there in South Scottsdale. When we moved there, out the door with utilities was $1,284 a month.
Yeah.
And this was 11 years ago. And I had not paid under $1,300 a month. I had cars that cost more than that, right?
Yeah.
Like, I couldn't believe that I was living in Scottsdale in 2015 for $1,300 a month with free coffee and a badass gym in the bottom and a pool. I could not believe it. Now, I haven't looked recently, but I think about 2 years ago, I looked to see what that unit was going for, and it was in the 3,500, $4,000 range, maybe. I can't remember. So my point is that, like, I could argue that we've peaked out on residential. You said you're doing industrial now, but where do you see it? Like, whether it's in Arizona or you mentioned Houston, like, where do you see the market heading and why?
Full circle. It's perfect because I agree with you. You know, I bought my first property in 2005. So I've seen that bubble firsthand. I was terrified 9, 10 through 12. It probably was 16 when I was like, okay, this thing's going the right direction, you know, because we just kept thinking 2008 was happening again. And when COVID happened in 2020, I sold my house in PV that I had built, you know, and it's worth double what I sold it for. And I bought a bigger, more expensive one, you know, after I watched those values go up a bit. So I'm not saying that I understand where the market goes necessarily. I think today there's a great argument for printing our way out and massive inflation again as we can continue to devalue the dollar. I also see weak consumer, you know, more consumer debt, lower savings rate. You know, I call 50-50. We go either way, but that's where I come back to cash flow. So the deals that we bought in our first industrial fund, which we just sold 8 of them week before last to a wholly funded a JP Morgan subsidiary, Zenith iOS. So I bought these properties in 20 and 21, you know, which would be considered, like, the last one was December of 21 and the earliest one was like January of 20. Produced over a 4 multiple on that vintage in that time period. I don't know of anybody, you know, I'm not saying it didn't happen. I'm sure there's data center guys and some guys who've done better, but we produced greater than a 4 multiple to our LPs on stuff we bought in 2021. We exited just a week and a half ago, and I couldn't justify their purchase. And JP Morgan, because I bank with them, their private bank releases this long-term capital markets outlook every year. And I threw it into AI and said, hey, help me decipher this 90-page thing. I've got extra cash. Where should I put it? It says you should put it into industrial and logistics real estate. And I'm like, no, ChatGPT, that's not where I should put it. I already have all my money there. Where do they say other people should put it? And it's like, no, that's what they say. JP Morgan's 10-year outlook, the best place you can put money is industrial and logistics real estate. And the group that bought our property, and I'll say these are not the nicest. This is not Class A infill, you know, not obsolete, but just infill. It was covered land plays. When I bought it, it was half replacement cost with below market rent. They paid me a number that I couldn't justify holding. We could demo everything and rebuild stuff. I could not get to a better number. So I wouldn't have sold the real estate today, but they gave me a number I couldn't say no to. And my fear is I'll turn that into cash and I will miss the next run up of, you know, I'll take kind of a low price. I put an escrow to them back in July of 25. We closed 3 in December and 5 more, you know, 10 days ago. I see the argument for both. So how I'm hedging against that, and I'm talking to the heads of family offices, smart private equity guys, the smartest guys and bankers I can find in the country I'm talking to about this. And I'm pleading a case for we're going to go down. I'm pleading a case for we're going to go up. So I'm riding it in the middle. And in that situation, the most important thing I can think of, cash flow. I want to be below replacement. That was the big takeaway for me from 08. You know how you get hurt? You pay double what you could build something for. That will lose almost every single time. So our whole thesis has revolved around, we want to buy below replacement cost with below market rents. And that is still the thesis I subscribe to today. And that's what I'm trying to buy.
Yeah, and I think to simplify, but I want to know if this is how you organize it in your mind as a guy who I would call an expert in it. You know, if you pay below replacement costs and we hit any kind of deflationary environment on the supply side, like electricians or drywallers all of a sudden aren't the most in demand thing, and now X amount of dollars per foot to build becomes X times negative 30%.
Yeah.
Then you're still okay because the cash flow worked out. And whereas if you pay double replacement costs and it cash flows, but now the replacement cost is 30-40% less, it's hard to sell it. And
you'd have to hold a lot longer in that scenario. Yeah.
You have to hold it a lot longer because if the tenant situation changes, which is the whole other thing, is, you know, what kind of tenants do you have in there? Then your mechanics go upside down on you and you can't get rid of it. I like a comment you said earlier, because it was the last thing I didn't buy in Arizona, but I was under contract and I was so ready to buy it. Was 40 units off 16th and Bethany in 2005. And it had traded hands like 2 times over a 2-year period.
Yep.
And it was 10 fourplexes. If you know the area, it was like 10 fourplexes right off 16th and Bethany. And at the time I knew nothing about Phoenix, but I rapidly got up to speed. It was the first time I'd really gone out there. So it was in a good quarter. That quarter today is a really good quarter. But I went out there and it was like 3.1 or 3.2 million bucks, I think, for the whole thing, if I remember right. Somewhere around 80 grand a door, maybe. Can't remember.
What year was that? 15, you said?
This was 05.
Okay.
This was right after I sold my last thing, which was my residential property in California, and exhaled that I had made it out before the thing blew up.
Yep.
And I'm like, okay, California's done. I'm going to go to Arizona because they're still printing 40% ARR. I could find a deal there, but I want to buy multifamily. I want to buy cash flow because, again, I was in that mode. And I tied up this property, and the guy actually sold, I think it was a Wells Fargo note, actually. But long story short, I ended up just flipping it because I got to a point where my final criteria, the pragmatist in me, was, who am I going to sell this to, right? I'm going to put carports in because there was no carports, right? So I was like, I'm going to put carports in, and that's going to be able to raise the rent this much and this and that. When we did the inspection, it was very heavy Section 8 at the time. Like, you know, a couple of the apartments had like nothing in it but a mattress on the floor and like two football jerseys in the closet. There was something that didn't feel right about it, but the math all checked out and the rent rolls all looked real, right? And the brokers were all, you know, giving me the one guy was a hoarder. I mean, my wife couldn't be. It was 108 degrees the day we did the inspection. I brought her out to see it before. I'd been out twice. Brought her out to see it, and the poor guy that lived there was mentally not all there, but literally there was, you know, dog feces on the wall, like that had been dried for years. I mean, like it was, I felt so bad for the guy who made $4,000 doing that inspection, crawling around in that thing. And some of the units were nice, but it was like, I'm going, okay, but it cash flows and it's 40 units and here's the depreciation and I can get a note for it. And I'm going to flip this in 6 months after I repave the driveway and put carports in. I'm going to flip this. And then I started doing the math and I said, would I buy this for myself? And I remember I got to a place where in order to buy it for myself, I'd have to put 40 to 45% down. And I was just like, I won't do that. And so if I won't do that, that's going to be a tough sell, right? If I won't do that, then that's going to be a tough sell. And so I knew a person who was from Chicago that like was an expert at multifamily and flip. He had just done a lot more deals. And I flipped it to him for $25,000. Like I was like, listen, just take the deal, whatever. I don't know whatever happened to that. I don't know if it went, you know, bad or not. I'm assuming it probably had a long, you know, trough of holding. But I just remember going, I can't buy this for myself. And if I can't buy it for myself, I probably shouldn't own it. And I flipped it to my buddy Corey and was like, listen, I just want my money back and I'll take a couple. I made like 20 grand on the flip or whatever, just, you know, like doing all the work. But And then I haven't bought a real estate cash flow property since, not because I didn't want to, but just because I got busy doing other things. But I think it's a good time to be in hard assets. And I think, that binary strategy of a barbell, like, hey, if it goes well, I want some money on that bet, right, for appreciation. But if it goes bad, I better have some strong cash flow that's defensible right here to ride it out. Because if I don't, then everything I made over here, I'm going to end up selling to pay off this.
Yeah. So this deal that I just bought, this ties into our strategy today because it speaks to what you're talking about. I paid $101 a foot for 340 some thousand feet. And this is basically, I think this is the apartment. The apartment guys made a fortune running up to that, and they made a lot of money through COVID. 20 to 22 apartment guys made a lot. Problem is most of them didn't get out. This building, right, 28 buildings, 114 tenants on 21 acres. And our purchase price works out to $100, $101 a foot. I'm also looking at developing small bay right now. If I wanted to build this product, I'd be $140 a foot just for the structure, before dirt, before carry cost, before cost of money, before any of that. It has an in-place 6.61 cap at closing. I got a positive arbitrage on the debt, but to what you just spoke to, our target debt these days is 60% LTV. We're putting 40% down, not because we can't get things to pencil with less, because that's kind of the institutional rule of thumb. Somewhere between 55, 60% is the widely accepted institutional gold standard. This is acceptable debt. You talk about a Prologis or the biggest guys in the world, they're going to be using debt. Now, you talk about single family houses that are managing billions of dollars, maybe they're past using debt, but that's a risk reward decision that everybody's got to come to on their own. But I used to use higher leverage. I've never been a max leverage kind of guy, even when I'm certain, just because we don't control the future. But that deal with an in-place 6.6, it produces a 9.9 cash on cash, basically from day one. It's got upside. With this particular deal was they had a fire life safety issue come up where they needed to put a few $1 million into sprinkler systems for changes in the fire code, because everybody would have underwrote that on the way in. They bought it in 20, great basis. But what they ended up doing was, with the renovations they had to create, they were only able to finish about 80% of the project. And when I say finish, I mean facelift, modern fixtures, finishes, institutional quality. So the building at closing was 82% occupied. And the remaining units, when you're talking about small bay is defined as 25,000 feet and under, but it's really your service residential customers. It's your HVAC vendors, it's your flooring guys, it's last mile distribution, small manufacturing. But these are the businesses that support the local rooftops. So we're a big believer of infill. I don't want the new big box distribution. I want infill. No new supply has come online. Growth of supply stock nationally has grown 2% in the last 5 years. And that's because small bay, by definition, is going to be a lower density product. You're going to have drive lanes. Think almost like a self-storage type configuration, except you've got like retail storefronts with roll-up doors in the back.
Right.
It's by definition low density. And the only way to make development work is to get a great yield on cost coming out of the ground, meaning Amazon distribution center. I'm going to buy 20 acres and I'm going to cover the absolute maximum I can. That's how I maximize my revenue, per land foot. This product is inherently backwards. So if I can buy this product in the middle of city centers where you couldn't replace it, just if that, my math there, the 101 against the 140 construction, we're probably talking north of 200 all in if you could add the dirt and the rest of the cost. So I think I'm half replacement cost on a product that'll last 100 years. It's an empty warehouse with a retail storefront that you can overhaul for nothing. And when I lease up that remaining 18%, we stabilize out to like an 8.6 cap by year 2. I'm giving myself 2 years to lease it up, and it's like a 9.4 with 3% rent growth, 3% expense growth, which is that's as low as any institution will allow me to trend. I would not trend at all. You know, a lot of the multifamily guys got screwed saying, we're going to have 10% rent growth over the next 5 years, and therefore I can give you a 15 IRR. Well, yeah, that math doesn't work, because we're not going to see that, right? This sector of industrial, we're still seeing rent growth. It's never stopped. It's continued to go up, and we have no supply. So I believe real estate at its core is a supply-demand problem. And if you have more supply than demand, you're screwed. I don't care how nice it is. If you've got less supply than the demand, prices and rents will go up. There's just no breaking the basic economic principle. So
yeah, I feel like we should do a part 2 of this. I feel like we should do a part 2 of this on specifically that asset class and kind of some of the approaches, some of the things that you guys are doing. If you're open to that, I think we should do a part 2 of this and kind of release it, because I think there's a whole conversation just around what you just said in the last 5 minutes that I know is very interesting to people, that a lot of people are not aware of, including myself, like the real nuances of that supply constraint, that cost replacement arbitrage, that use case of what happens when a major infrastructure provider comes in and builds out, but then has excess acreage or excess things that is near a city center that, you know, is just looking to basically maximize cost per foot. And, you know, again, a world where Uber Eats and everything else just continues to go, and you have these last mile logistical issues that are small business centric. I would love to unpack that a little bit deeper on maybe a part 2, very specific around that, if you're open to it, because I know we got to kind of wrap this episode up. But where's the best place for a high net worth family individual that's, you know, investing in cash flow and hard assets? They want both. To connect with you? Is it LinkedIn? Is it the website? We'll put it on the show notes, but where's the best place?
Our website, Hanson, HANSONRE, like real estate, for hansonre.com. We've got contact forms there, and that's probably the best. I'm not a huge LinkedIn guy. We post to there, but I stay away from most of that stuff. Happy to talk to anybody. We've got a great investor relations team. But yeah, I think that'd be a great idea. We could unpack. I did gloss over a ton of kind of macroeconomic principles and how we bring all those together.
I want to do a part 2. We're going to release a part 2 with this episode, because you and I have a lot more to talk about. I think we've done a good job with this one, kind of demonstrating why we want to listen to you and why we want to pick your brain more. And I think you and I could really nerd out in a way that's meaningful to the listeners if we focus very specifically in on now, what are you doing and why are you doing it and what's your thesis? Yeah. And I want to have that conversation with you for your sake, for my sake, but also for the audience, because I think it merits it. We haven't done an episode 2 follow up yet, but this one definitely merits it. And let's get that booked. So we'll bring that to you guys. We'll make sure that when you get this one, you get the second one. But Chris, it was a pleasure getting to know you and having you on the Atomic Level. I look forward to part 2.
Yeah, love it. Thanks for having me, Chris. Look forward to it as well.
Awesome. Check them out, guys, and we'll see you the next time.
It's time to go to the atomic level. It's time to go.
Welcome back to part 2 with Chris Hanson on the Atomic Level, the show where we decode the matters of wealth one insightful conversation at a time so that you can grow and protect your net worth and net happiness. And in this section, what we're going to do is go deeper on the mechanics of actually what Chris and Hanson Capital are doing, because I think it's actually really unique, and I want to learn and unpack it in depth. So thanks for coming back. Good to see you again. Let's get into the weeds now of what you do. We spent the first hour and a half really kind of getting to know you and the firm and your kind of track record and just how you got here. But now I want to get into like the market dynamics as they sit today, your perspective, and really, you know, empower investors that are either doing self-directed stuff or maybe looking into some alternative asset classes with kind of your unique
lens on where commercial is and what you're doing about it. So I'll let you kind of start where you think is best, but think about me as the guy you're educating on the business model and the evaluation model, and I'll just kind of go from there.
Sure. Thanks for having me back, Chris. This is an exciting topic for us because I think, as we alluded to last time, we've pivoted opportunistically across the asset classes when we saw something that was mispriced. And with where industrial real estate is, or even commercial real estate in general today, we are focused on this small bay multi-tenant, specifically the infill stuff, whether that is acquisition or ground up development. The economics of it are just, they're what makes sense. And we're leaning a little more towards acquisition than ground up today, just because if we can buy in place income, we will. There's no reason to take development cycle risk when you can buy, the deal I mentioned in brief last time, we bought a 6.6 in place income, 6.6 cap. That thing stabilizing into a mid-8s within 24 months with, really conservative timelines. I can't build much better than that. In fact, we're looking at a deal right now that would be ground up. It'll probably be a 24-month development cycle, and it'll stabilize to about an 8.1. Now, new product is great, right? But jump in anywhere you want there.
Yeah, no. I don't want to cut you off, but I want to like layman's term some of this out, because even if people have experience with real estate or commercial and they know what a cap rate is, I want to take some of the vernacular and just calm it down, right? So in other words, infill, like I think I can explain that to someone, but what's the succinct way to layman's term what infill is?
Well, when we're looking at real estate, we can look around the city centers or we can look on the outskirts. And a lot of guys that focus on land development will basically go to the edge of town, buy dirt where it's cheap, and wait for the path of development to envelop their site. Their land value goes up, and that's kind of speculative buying land.
Right.
We want to avoid that for the most part in an infill strategy. Infill being maybe there's a parcel that's still lying around inside the city, or maybe it's a repurpose. We're going to buy, an office building, tear it down and throw some small bay development in there. Anything that's within kind of metro centers could be technically classed as infill. I don't know that we're using, like the institutional real estate dictionary for the description, but
I think that makes sense. I wanted to hear how you would say it, because I would have probably been wordier, and that's why I wanted to hear you say it. But like when I visualize that in your market, for instance, where you're based right now, I know you invest all over the country, but in Phoenix, for instance, when you're driving into downtown and you get off the exit, there's all the president roads, right? Like Van Buren, like all those, and there's buildings, like there's the science center and there's the things, and then there's the high rises in the core, but there are lots or vacant buildings or old things that are kind of just sitting there. And so what you're talking about when you're talking about infill is figuring out, does that thing have already existing income, and and is it zoned properly in this case for small bay? Like if it isn't, okay, well, what's the risk there? But you're talking about basically either looking at building inside of one of those dirt lots or teardowns on the way into town, and that's the infill side. So when you say 6.6 cap rate in place, that means the price that you're acquiring it at and the cash flow turn into a 6.6 with the current tenancy, with current whatever. When you say
earning at closing,
right, like the minute you take over, you're basically getting 6.6, right?
Correct.
When you say stabilize around 8, again, layman's term it out. What is the path to that, and how long is that? And is that because you are raising rents? Is that because you are swapping out a tenant? What is the reason why it stabilizes at 8.1, and how do you drive to the certainty of that?
Great point, Chris. We could spend 15 minutes going on what I just said in those 30 seconds.
And I'm happy to, because again, I think part of what we're trying to do here is educate people on if they were doing it themselves or if they were just interested in it. But the other side of it is to really demonstrate kind of the thoroughness of how you guys do it in your unique way. So I'm happy to go into the weeds. That's the point of this second part, because as much as it is educational, it's also time saving. If somebody wants to take action, it's like, okay, well, now I understand it better.
Yep.
But I'm just going to go pick the person or the fund that's going to do it. And if it's Hanson, great. And if it's somebody else, at least I now know the questions to ask, right?
Exactly.
I'm evaluating.
You know what? We've got a webinar series that we have the 4th one coming up in about 10 days. That's on one of these topics. Our first 2 focused on questions limited partners should be asking when they're looking at alternatives, whether it's with us or otherwise. We're happy to educate on that. I'll give you
We'll put those links in the show notes too. We'll make sure, and also the way to sign up for the upcoming one, because this will air before that. So let's make sure we do that, because I think that'd be a tremendous resource for people to take a look at. So
absolutely. But let's go back to those questions. As you said, the 6.6 income, that's today. Income existing, and that's a significant number, because you would be hard pressed to find deals. Prevalent cap rates are going to be usually lower than that today. So that in-place income is better than what you'd expect. We've been searching for that stuff. We search, all day long. We've got an acquisition team. If we could find 6.6 caps to buy every day, I wouldn't be on the show today. I would be, writing checks and figuring out how to buy more deals all day long. So the in-place 6 and then stabilizing to a mid-8, 8.4 and change, meaning after we execute our plan, and there are a variety of different plans that go into that. In this particular case, the sponsor or the selling group didn't finish their renovation plans. So it was 82% occupied at closing. That remaining 18% of occupancy or vacancy, I should say, is suites that are not in rent-ready condition. If you were to compare it to a value-add apartment deal, you'd call them down units.
Mm-hmm.
Not because, they don't have a front door and you got to put a bathroom and a kitchen in. Just it isn't at the standard that's leasing in the current conditions today. So fairly light construction work. I think we had to do permits on like 3 bays, and we could get away with 8 of them without even needing a construction permit. Surface level, flooring, paint, lighting, that kind of stuff. Very low complexity construction to bring it to a market ready leasable standpoint. And then we're planning to lease those units up over the next 24 months. And as we stabilize those, or stabilize the property by leasing those and bringing it to normal occupancy, which sub-market occupancy in there is between 3 and 5%. We'll just say 4% vacancy as an average. It depends on the bay sizes, but we should be in that 96 range. Today we're at 82. That 14 points of occupancy that we're going to fill up materially raises the income, because it's already making money. If it's producing a 6.6, every extra dollar of revenue is essentially going to the bottom line. We stabilize and fill it up to get into a mid-8s yield or stabilized cap rate is a great place to be. We have an opportunity to resell it at that point and make a great return on our investment, but we will likely hold it as we assemble more of these, because that's kind of where our specific business plan creates value, by assembling these where the sum of it is worth more than the individual parts when we get a bigger institution to buy the package from us.
And I would imagine when you're doing that, you're trying to sell it down in the 4-5 range of cap rate, or is that aggressive? Is that aggressive for small bay?
I'm not familiar with, I wouldn't say that's a stabilized cap rate where you would see an exit today. I am seeing deals where we're competing in the buying process, where deals are trading in the high 3s to mid 4s, but that's with a value add play to come. Those guys are buying a current 4.5 that they can get to maybe a 6.5. And then if they could sell it at 5.5, that's their premium that they're able to.
So if you stabilize it at 8, what would you be? And again, I know you're not thinking about dumping this overnight, right? But in other words, if you could stabilize it at 8, and let's say in 24 to 36 months, market conditions are a place where you'd like to be, is the hope to sell it at a 6? Is that where would you like to be in the plan?
Yeah, I want to state this specifically so that I don't get it wrong. I'm just going to pull up the opportunity summary. Another link I'll probably throw in there for you guys. We're underwriting. Now we handicap our deals. Our exit cap rate, which produces a 1.42 multiple, is a 6.75 cap rate. That's above our going in cap rate because we want to stress test it up. If I tell you we're going to achieve a 1.4 multiple on this deal, it's a 20.07 IRR on a 2-year execution, and I end up hitting a 25, you're not going to be upset with me. But if I end up hitting a 15, well, hey, we didn't quite hit the model. So when we've got a lot of confidence in these deals and we know like this deal, we paid $100 a foot, way below replacement cost. We're
Right.
going to handicap our underwrite to basically look at it from a stress test. We don't know that cap rates go down in the future. We don't know that cap rates go up. We can see comps that are in the 5s. We don't see any comps above that 6.75. Certainly not for a stabilized product, right? If there's work to do, maybe.
What's the motivation on the sell side that you're coming into today, or that you see out there in small bay specifically as a niche piece of commercial? Because it may be different than multifamily, or it may be like the motivation may be different. Maybe it's not. Maybe it's the same. Maybe it's always
You mean
the
like, why are the sellers selling today?
Yeah, why are they selling something that's thrown off a 6.6 today? Because it's cash flowing.
Yeah.
With light, and I'm playing devil's advocate because there's obviously a reason, but I'm just curious if it's a one-off reason, and it's just like because you've got really good ways to hunt and